Everyone, and welcome to our webcast, Tax Planning for what should say the administration as opposed to the new administration. I'm Justin Allard, a tax partner with Battelle Battelle. I'll serve as our moderator today, and our speaker will be Sam Hemeter, a tax principal with our firm. Sam earns BS in accountancy from Wright State University and his master's in taxation from Capital University. He has 17 years of experience, including 13 with one of the big four firms. Sam's experience includes tax planning consultation with closely held and SEC clients in the manufacturing, energy, financial services, real estate, and distribution industries. He's worked with a variety of clients assisting with business succession, merger acquisitions, international structuring, state and local taxation, and accounting method opportunities. Sam is the Ohio Society of CPAs and the American Institute of Certified Public Accountants. Before we started with the presentation, a couple housekeeping items to touch on. You should have all received a CPE credit information sheet. If you're interested in obtaining CPE for this session, please fill out the information on the CPE verification form. I will be asking verification questions throughout the discussion today. And again, if you want CPE, please complete that sheet and send back to Nicolette Jett as instructed on the CPE credit information sheet. And there is a percent evaluation sheet that should have been sent out as well. Certainly welcome any feedback and input you have about our presentation today. As with the CPE information, please send that back to Nicolette Jett as instructed on the evaluation form. There is a mechanism to ask questions in the lower right-hand portion of your screen. As we go to slides, please feel free to chime in and type questions. And as a reminder before I turn it over to Sam, we'll have another webcast on December 11th. That's going to go with international employment matters. So to the extent it's on the phone is employing individuals abroad and dealing with some of the challenges and issues you face internationally. We'll be hosting a session with Joe Daner from Frost Brown Todd to talk about some of those issues. I'll turn it over to Sam.
Thanks, and I want to thank everybody for attending. And as Justin indicated, feel free to submit your questions if you have them. I appreciate attendance and welcome feedback. Okay, so let's move on to the first slide, and I just want to cover our agenda for today. We're going to spend a little time talking about the legislative landscape, where we are, election, kind of the makeup of the House and Senate, and those types of items. And then we're going to kind of dive deep into planning for high-income individuals. The focus of this presentation is on folks who are high-income because, by and large, the changes relate to or proposed changes relate to folks who have $250,000 or more married filing jointly. And talk a little bit about business tax planning. So for that, let's get started. Legislative landscape, most people are aware the Bush tax cuts are set to sunset on January 1st, 2013. And what it means is that the current capital gains rate of 15% and qualified dividend rate of 15% are sunset, which means that they'll go to 20% for long-term capital gains, and for qualified dividends, they'll go to the top marginal rate, whatever that might be, on January 1st, 2013. As it stands today, that top rate will be 39.6%, ignoring the surtax for Medicare. We're going to talk at length about here shortly. Where we stand with the election and Obama's, re-election, he will maintain veto power, and so a lot of us are speculating that will help shape negotiations over the next few weeks to solve, if you will, or prevent the fiscal cliff from occurring. Historically speaking, we had a similar dynamic in 2010, in that the Bush tax cuts were set to expire. During the lame duck session of Congress that time, they decided to extend those cuts. That was after a midterm election in which the Republican Party took the House, such that I think the input, the momentum in legislatively was such that the Obama administration was more apt to concede those cuts. At this point, there's more of a sentiment or a feeling, at least, that the administration is going to push the agenda a little bit harder, such that their view of the world, taxing higher folks more, is what they're going to try to attain here. But a sentiment that they may ultimately just kick the can down the road. We may have meaningful legislation in a number of months, but not over the next 4 weeks.
The observation I would make, I think if you follow this in the media, it seems like Democrats are talking a fair amount about extending the Bush-era tax cuts for those who are less than $250,000 a year. The one comment I would add to that is that this morning on my daily tax updates, I actually read for the first time where 2 Republicans were quoted being open to the notion of having the Bush-era tax cuts actually expire for the higher income taxpayer. So I think historically that delineation has been along party lines in terms of whether we extend these for one or whether we extend them only for those earning less than $250,000 a year. And again, for the first time today, I read a little bit about a couple of Republicans that seem to be at least open to the notion, if not endorsing the notion of taxes going up for those earning more than $250,000. That's
exactly right. I think, based on what we know today, that folks who are in the range of income of AGI of $250,000 or more should be planning as if their tax rates are going to go up. And we'll get into the details of that here in a second. Let's move on to the next slide. So one of the taxes that we know, at least today, that will increase related to tax enacted as part of Patient Protection and Affordable Care Act, commonly referred to as Obamacare. This is I think a lot, by and large, the public hasn't paid much attention to, but it applies to folks who have high income levels, and it applies regardless of the Bush era sunsets or tax cuts. Such that this is totally independent, and it's part of the law currently. It is effective on January 1st. And this applies to high income individuals. There'll be a new Medicare tax, 9% on wages above a certain threshold, January 1st, and a new Medicare tax of 3% on net investment income on high income individuals. Again, I want to stress the fact this only applies to folks with relatively high AGIs. So let's move on to the slide and kind of drill down what that means. This 3.8% applies to the level of net investment income or the excess of AGI greater than the threshold amount. Mod AGI is basically your adjusted gross income, and if you have a foreign earned income exclusion, you get that back. So it's the lesser of two numbers, and it's 3.8% of that. And the total amount for May filing joint taxpayers is $250,000 of net AGI. So that's that threshold that Justin mentioned earlier, and seems to be kind of if you line in the sand where tax rates start to kick in at a higher rate. One observation on this net investment income tax, I think from a policy perspective, both Medicare tax and the FICA tax have historically only applied to earned income. So this is certainly a change in policy to take one of those two taxes, specifically the Medicare component, and the decision is made to apply it not only on earned income, but on unearned income. So again, let's not lose sight of the fact, yes, this is an additional tax, but I think it certainly represents a significant policy change on the part of Congress and the administration. Right. Great point. Let's go on to the next slide and talk about what net investment income includes. Basically, it includes all taxable sources of income, if you will. So taxable interest, dividends, capital gains, annuities, rents, and then passive income from through entities. And let's next slide and show a little example of how this will work. that's filing jointly and that has $200,000 of earned income, a salary, and then $50,000 of net investment income, the tax applies to the lesser of the $150,000 of net investment income, or their total AGI of $350 less the threshold amount of $250 for a subtotal of $100,000. So the lesser of the $150 or $100, and so the third tax is due on $100,000 and would be $3,800 of additional tax due. So again, disregarding any book era sunsets, this isn't the capital gains rate increase or the potential rate increases due to bracket changes, just a new tax that was enacted as part of Obamacare.
One comment on this, I was at breakfast with a couple of professionals this morning, and I was attempting to explain the way this tax worked. And their question to me was, if I make less than $250,000 a year, do I have to worry about either one of these taxes? I think that is no. Sometimes it's easy to get confused by the mechanics and some of the thresholds. The bottom line is if you have an individual making less than $250,000 a year, you really don't need to worry about the additional 0.9% Medicare tax on earnings or the 3.8% Medicare tax on investment income.
That's correct. Let's talk to you of a few forms of income that will be excluded from this new surtax enacted as part of Patient Protection Affordable Care Act, also known as Obamacare. Exempt interest from municipal bonds is not this tax. IRA and qualified plan distributions. If you have AGI of over 250 and you're getting these distributions, those distributions will not be subject or included in the definition of net investment income. Social Security income is not included. Life insurance proceeds are not included. And these are generally items that are excludable from income under the current tax code. The income and the cash surrender value of your life insurance policy. And for flow entities, if you own an interest in a partnership or an entity that's taxed as a partnership or corporation, any active income, so if you're active in that trade or business, any ordinary income that's considered active would not be subject to this tax. So as an example of an LLC member or S corporation shareholder, typically, I guess the passive and active distinction was necessary from an income tax perspective because of what's known as the passive loss rules. On a good basis, they're going to have to work through whether they're passive or active for purposes of this new surtax. And so in this example, John owns an S corporation. His share of its profits, it should say, not at its profits, $1 million. He is considered passive in that S corporation activity. If he's not active in the trade or business, that tax would be $38,000 to him. So that distinction, and he may want to revisit his level in that business operations to minimize his tax bill.
One comment on that, Sam. There are several different tests that you can meet to qualify as a material participant in an activity. One of the things I think that our clients are working through with us is there a way to aggregate perhaps one activity where they are currently considered passive with other activities such that they would meet the material participation requirements overall. There are some grouping rules in the passive activity law sections that allow you to group certain activities in what's called an appropriate economic unit. So that may be one of the things that we need to consider going forward is regrouping activities. So, for example, if you had 100 hours spent in each of 5 different activities, you have to actually group those all together and consider them all active or material participation, as opposed to looking at them individually and treating them all as passive.
It's just a simplified example of life insurance, the inside buildup of the life insurance cash surrender value on a policy, and how it's exempt from tax. Basically, an individual who pays a $250,000 premium for a $2 million whole life policy, after 10 years, the value of that policy, inside buildup, is $50,000. He draws $50,000 from the policy. That $50,000 withdrawal is not subject to the surtax because it does exceed his basis in the contract. Have any surtax implications until his cumulative withdrawals exceed $250,000. A little bit on how this new tax will apply to trust and estates. For us to trust and estates, a lot of high net worth individuals, we have traditionally planned around the income tax brackets for those entities because the higher rates kick in at lower levels. We've tended to do what we can, I guess, to strip the earnings out of those entities, and the income flows taxed to the beneficiaries as opposed to the estate. And under this new Meta tax, the analysis remains the same, and that 3.8% applies to the a lower threshold of $11,650 for an estate or trust. So let's do that a little bit. The nice trust is they can make a deductible distribution, in essence, to their beneficiaries. Again, so it would be odd, I think, in this day and age to see a trust or estate pay income tax at the higher brackets if their beneficiaries were in a lower bracket. So the plan is to just simply make a distribution to the beneficiaries. As an example, this next slide of how that would work, we have a family trust that has $100K, $100,000 net investment income, interest, dividends, capital gains, has $1,000 of deductions, including the estate or trust exemption amount. Assuming beneficiaries are in the 28% bracket, and the beneficiaries are not subject to this surcharge individually because their AGIs are below the $250,000 threshold, they would save income and surcharge taxes of $21,000 if they merely distribute the trust taxable income to themselves. So fairly simple. Tax planning can save them quite a bit of money.
Let's jump in with our first CPE verification question. And the question is, what is 1 plus 1? Again, 1 plus 1.
Okay, the slide is just a little bit more planning, or it should be given to high net worth, high income individuals around this surtax. These steps relate to vehicles that allow folks to essentially manage their AGIs. One vehicle for that is a conversion from a traditional IRA to a Roth IRA. So the nice thing about converting amount from a traditional IRA to a Roth is that you can do a partial conversion. So if you're currently $150,000 and you've got a $4,000 IRA sitting out there, if you convert $100,000 of that, you'll still keep your AGI below the $250,000 threshold to keep your shelter your net investment income from this surtax. The same is said for charitable remainder trusts. There's a lot of flexibility in making distributions for those if they're set up correctly. It's another vehicle that if you have a charitable remainder trust, you might look at your current distribution needs and try to manage those to keep your AGI below the $250,000 threshold if you're married. Some more for high income individuals is related to individuals who own closely held businesses and sell those business currently under the income tax laws. If you sell a business and receive payments over a period of years under the term note, or a part of the purchase price is financed by a note, the installment sale method applies, which would require that you defer recognition of some of the gain to future periods. Well, obviously, when you know your income tax rate will be higher future periods, it's in your interest to not defer. Generally speaking, you have to run the numbers to be sure of that. But the bottom line is, individuals have the flexibility to elect out of this treatment if they so choose. And the beauty of the installment method, electing out of it is as simple as merely reporting the entire gain on the 2012 return, and you have the benefit of hindsight if you extend your return on April 15th. You file it right around the 1st of October. Let's say you received a few payments there between April 15th and October. You have the benefit of hindsight of either electing out of it or remaining on the installment sales method.
One opportunity I would mention that's along these same lines is with to portfolio assets where you may have unrealized gains. If you think about this, right now we're looking at a 15% capital gains rate at the federal level. Risk does not act, particularly with income over $250,000 a year. Non-capital gains rate, the basic rate goes up to 20%. By the time you add the 3.8% tax on net investment income and potentially factor in something we're going to talk about in a few minutes called the PEAS limitation, which is a kind of itemized deductions, the tax on capital gains, believe it or not, is going to go up in the range of 60 or 65% when you add up all those taxes.
Yeah, the increase in the rate itself will be, the marginal rate on the gain is not 60 or 65%, just the increase in the rate itself. Yeah.
So one of the things to consider is if you do have assets sitting in your portfolio with unrealized gains, say assets before year end, and in effect stepping up the basis and paying tax at 15% versus ultimately be close to 25% on capital gains if Congress doesn't act before year end.
Yeah, gain harvesting is something that most investors should be considering right now. For further clarification, but if you know your AGI is going to be over $250,000, your tax rate is going to be this 3.8% higher than what it is currently. So harvesting some gains is not a bad idea if you feel like those securities are fairly mature and that their value not increase in the future.
Yeah, and we can say pretty confidently is that tax rates aren't going to go down.
Yes.
So even if you were to liquidate some securities with gains on them, in case scenarios, you're prepaying a little bit of tax at what will arguably be the lowest rate for a long, long time.
That's correct. Then it deals with a little bit more estate and trust planning. The deduction for estate and trust income tax return mentioned before. There's a little flexibility in the code to allow that to be applied retroactively if the distribution is made with 65 days of the year end of the trust or estate, such that the firm who is doing the return to the trust or the estate income tax return has 2 months or so after year end to blow down the numbers and make sure they understand how much taxable income there is in the trust and then make the distribution and out that trust income. The next aspect on this is for the state income tax. That's around the state, technical income tax due on the income generated by those assets has to file a separate income tax return. It's taxed as a separate entity. So there's a little bit of planning that can be done relative to estate income taxes. And essentially, estates have the flexibility to choose their year end, and because this tax applies to years beginning January 1 or following, have an estate currently, you might want to think about selecting a year ending 30th, 2013, a year beginning December 2012, thereby avoiding this tax entirely on a whole year's earnings.
Jump in with our second CPE verification question. Again, this is question number 2. What is 2 plus 2?
That's the question. The next slide touches on the concept of just kind of planning around deductions. Traditionally, traditional tax planning in an environment where tax rates will stay the same or not increase. Traditionally you would want to accelerate deductions and defer some items. Well, we're in an environment for folks who have higher income levels where they want to think the opposite direction, generally speaking. They would accelerate income, and in some cases defer deductions, but in some cases not. So we'll dive into that a little bit here. So they want to accelerate itemized deductions into 2012 and avoid P's limitation that Justin mentioned earlier. Speaking, you would think you would want to do that. One caveat, if you will, that I'll throw into that you know, us guys like to do is make things more complicated, is that a lot of taxpayers in these brackets, in these upper income brackets, are in the alternative minimum tax position. Such accelerating certain deductions really will not reduce their bill, because those deductions are now allowed in AMT. Those are deductions like the state and local income tax, real estate taxes, and those types of items.
Yeah, the comment I would add there is there has been a bit of discussion both in the presidential debates and after that about the notion of limiting total itemized deductions for higher income taxpayers. Even though that notion was really first surfaced by Mitt Romney, it seems to have gathered some momentum, and we've seen a little bit of dialogue in the press about that even post-election. Yeah,
you touched on a great point. I mean, part of the Romney campaign's philosophy was to lower rates across the board, but then to deductions for those making higher income levels. And the Obama administration is also behind this Pease amendment, which was a little bit different than what Romney was proposing, but in the same vein in that it limits the ability of higher income taxpayers to deduct itemized deductions. Let's shift gears a little bit here and talk estate and gift tax planning. State tax regime, they're starting 2013, the exemption amount on cumulative gifts made over your lifetime in your estate, the exemption amount's $5 million currently. That to be reduced to $1 million, so that's a significant drop for an exempt lifetime giving and estate, kick in on January 1st. So, and the current rate on gifts is 35% and is set to go up to 55%. So it's a 50% tax rate. I mean, the tax savings of making a gift now versus making a gift in the future, let's assume that you would use the full $4 million. The $4 million excess current exemption amount over what it looks like it's going to be based on law at 50%. It's $2 million of tax savings, so it's significant. There's a lot of speculation that the exemption amount will not go from 5 all the way down to $1 million on January 1st. It only go down to $3.5 million, which is what Obama had in his Green Book, I think 18 months ago or so when he came out with that. But at the end of the day, you're really not harming yourself taking the current exemption amount. Then, I guess, certain law firms in the marketplace who are express concern that this may retroactively try to tax amounts gifted in excess of whatever the exemption amount becomes at December 31st, but seems somewhat impractical and unlikely in that it's very difficult for them once he makes a transaction under current law to try to tax that by actively enacting something. It just doesn't seem like that's very practical. and it seems like the consensus is that there's no harm in advantage of the $5 million exemption amount now.
So a little bit further on that, I think some of the concern on this front is stemming from the nature of the current estate tax calculation. The way the estate tax calculation works right now is you start with the gross estate, you add in lifetime transfers, and until this point, you've always just subtracted out this exemption amount. Well, it is, if your current gross estate is $5 million, you've made $5 million of lifetime transfers via gift, mechanically, if that exemption amount reverts back to $1 million, you're going to end up with a $9 million taxable estate. As Sam indicated, I think a lot of practitioners out there feel that that end result is unlikely for reasons. I think one of the more components, in my opinion, is if you think about somebody making a transfer of $10 million today to children, they don't gamble the money away in Las Vegas, and the client passes away 20 years from now, they don't even have the wherewithal to pay it. I'm not even sure how Treasury would plan to collect those assets given the fact that they left the estate 20 years ago and were spent away.
One important, point to make about high net worth individuals who might be contemplating making these gifts. A lot of folks, and I used to be one of them, think that making a gift means that you lose total control over that asset. Simply not the case if you use more sophisticated trust planning, maintain a certain level of control over those assets and still have it be considered a gift. So it's the best of both worlds. So the next just kind of touches on some of the concepts that we just covered. And, along the lines of the trust planning that I just mentioned, interest rates are historically low right now. Certain split interest trust planning is very value added currently. You couple that with the exemption amount, and if you have a $10 million married couple with a $10 million estate or higher, they can take advantage of some nice charitable giving tech or retained annuity trust techniques and enhance the net worth they pass to heirs relatively tax-free or virtually tax-free. Here's again now to business tax planning. Currently, businesses are allowed to claim what's known as bonus depreciation on new assets placed in service in 2012. That is to expire January 1, 2013. The bonus currently is 50%, such that if a manufacturer buys $1 million equipment, they can deduct $500,000 plus of that new equipment in 2012, whereas in 2013, that back to taking the normal depreciation on that $1 million asset, which may be more in the range of $200,000. One little trick to bonus depreciation I think is not often considered, but should be, is that for individuals who own flow-through entities and are in an AMT tax position, bonus may actually be to their detriment because it may drive them deeper into AMT. It's a really complicated concept, but I've seen that numerous times with income individuals where it frankly does not make sense for them to claim bonus. They'll pay more tax over that asset than if they just depreciate using more traditional depreciation methods. And then the thing to consider is that because Medicare surtax is kicking in January 1 and maybe or possibly higher brackets for folks making over $250,000, you may want to defer depreciated deductions on it at the future period. So I had a client that was looking to buy a fairly expensive piece of equipment, owned through a pass-through, and we decided that it was in interest to elect out of bonus depreciation and actually use a straight-line method of depreciation by getting the most bang for his buck out of deductions in future periods at higher rates.
Yeah, and to reiterate that, so there's really potentially two benefits. Payment of alternative minimum tax can oftentimes be a permanent difference, so you could permanently be paying alternative minimum tax and then really losing the rate arbitrage if you believe rates will revert back to 39.6 between the current 35% rate for those deductions and what 39.6% beginning 2013.
That's correct, and the best way to know whether it makes sense to claim bonus or not is to really run income tax projections for 2012 and then all future years that the asset will be depreciated and get the total tax bill under one scenario versus the other. Because it's amazing, this 3.8% tax adds up pretty quickly on a big piece of equipment. So just add in the back of your mind. With that, next slide, and this is more, I guess, business tax planning around deductions. Currently, there's under the Code Section 179, there's an expensing election for business that place assets in service in 2012. Currently, that the available expense amount is $139,000, and it's phased out if your total additions of assets exceed $560,000 during the year. That is set to revert to a expensing election amount of $25,000 and out starting at $200,000 on January 1. So obviously, if you can take advantage of the Section 29 deduction and are considering doing or buying equipment, this is the year to do it as opposed to doing that on January 2nd or 1st of 2013.
There's been some discussion in Washington about the notion of extending the bonus depreciation provisions and or the Section 179 amount at the higher levels, but we really don't know what's going to happen. Again, I think to some degree that may depend on what the economic numbers look like in the coming months, but there is a possibility that both of these provisions could be extended beyond 12/31/2012, but I'd be more inclined to plan based on the law as it stands today as opposed to what we think it might be in the future.
Yes, agreed. Good point. More with business tax planning, and it's more related to closely held companies, both corporations and S corporations. Shares of those companies should consider dividend distributions to take advantage of the current historically low dividend of 15%. The nice thing about owning your own company is you can choose how much and when to make those distributions. And given that we know surtax is going to apply next year to higher income folks who own these businesses, and we think we calculate that capital gains and qualified dividend rates are going to go up based on the current law. I think it makes sense for those types of companies who have been historically profitable to distribute some of those earnings now to their shareholders. In fact, we're working with some companies who are considering just stripping out all of their retains, if you will, to take advantage of this lower rate, because at some point those are earnings that they're going to pay that second level of tax on it, and some of those that we work with are concerned that they're never going to see a 15% rate again, so take advantage of it while you can. Other kind of point to consider is that for flow-through entities that own foreign subsidiaries, any unrepatriated earnings built up in those subs and that can be repatriated, to capture that % rate. Obviously, if the foreign sub needs the cash flow, the shareholder can turn around and recontribute that cash as needed. Obviously, with assuming that they dot their I's and cross their T's with respect to the local law there relative to taking cash out of the country.
One additional comment on that front. I actually have a client who has this issue staring them in the face as we sit here today. They have significant deferred income sitting in a foreign subsidiary. It's currently as a corporation. I reiterate the potential differential we're looking at. If they were to trigger a dividend back to the U.S. today, taxed at 15% at the federal level. It's possible that if they trigger this income or repatriate it in 2013, that the 50% rate will revert to 39.6, and I still think there's a bit of a question mark as to whether this 3.8% additional tax could apply to that. So at worst case scenario, 15% versus 43% and change, which is obviously significant. And the final point I'd add is there are some ways to trigger a deemed dividend into the U.S. tax return as opposed to an actual distribution of cash. So we have a foreign subsidiary that needs to hang on to the cash. There's some U.S. tax elections we could make that could trigger a deemed dividend to take advantage of this 15% rate.
Good point. And not to prove this point, but S corporations have the same ability to make some elections if we're a C corporation at one time and have some historical C corp earnings and profits or retained earnings, as most of us think of them. They can make an election to, or they can make an election to deem that amount is distributed to them, tax now at 15%, and avoid potential tax rate increase. Fairly basic idea to save a little bit of money relates to C corporations. If you just think about a year-end bonus of a C corporation, if paid today, we really don't have much in terms of a net tax liability associated with, let's say, a $100,000 bonus. We got on the C corp side likely at 35 cents on the dollar. We have inclusion on the recipient side at 35 cents on the dollar. If you delay that until 2013, if the rates do go back up and you have a higher income taxpayer, the after-tax amount changes a little bit because we still got a deduction at 35 cents on the dollar. For our income taxpayer, you've got income inclusion at 39.6, plus if they're over $250,000, the 3.8% surtax on top of that. So really just a year-end bonus, paying it out in December versus deferring it till early 2013 can make a meaningful difference in after-tax take-home pay. And I neglected to add this to this slide, but it probably been, we have quite a few clients who manufacture here and then export goods overseas, and they're taking advantage of what's known as a DISC, the International Sales Corporation. The reason DISC is beneficial is that the client gets essentially a rate-lodged deduction. So the deduction is tax affected at 35% currently, income included at 15% on the qualified dividend rate. Well, if the dividend rate does go to 39.6% plus, and obviously the DISC is no longer as attractive. In fact, it's unattractive. So something to keep in the back of your mind if you're working at a manufacturer or own a manufacturing facility and are taking advantage of the DISC. Keep your eye on dividend rate here. We're speculating that it will go up. In current law, it will go to 39.6% on January 1st. We give a certainty that's where it will be, but keep that in the back of mind. If you are an exporter and haven't set up a DISC, you consider that as something you want to do in the event that they cap the qualified dividend rate at 15 or 20% here over the next few weeks, or can down the road and move the Bush-era tax rates for a year or so. So we'll move on to the last slide in the presentation. And talk a little bit about the R&D credit. A lot of our clients take advantage of that credit, and unfortunately, that is a credit for businesses who do qualified research and development, not renewed, and so it does not apply to from January 1, 2012 forward. But historically, Congress and the President have renewed this every 18 months or so, and make some positive headlines that they have given taxpayers this great tax break. I expect that this will get renewed. I can't remember the last time the R&D credit not renewed, so keep that in the back of your mind. But it hasn't yet, and so there's a possibility, a slight possibility, that it won't be. And also, as part of the Patient Protection and Affordable Care Act, there was an excise tax passed and enacted that applied to medical device manufacturers starting January 1st That's a brand new tax that, frankly, I've not worked with. My client base does not include medical device manufacturers, or at least if it does, I haven't spent a time working this. So my understanding is it's a fairly broad tax, and it's an excise tax such that those manufacturers have to charge that tax on and pass it on to their customers.
I'd like to ask the last CPE verification question. Again, verification question number 3, and the question is, what is 3 plus 3?
That concluded today. I want to thank everybody who attended and thank Justin for moderating this. And I'm sure Battelle Battelle will be, staying on top of the legislative situation. And to the extent that we do have a more clarification where the tax rates are going to be in 2013, if there is legislation over the next month or so, as there was in 2010, then we'll maybe stay on top of that and have another webinar in late December, early January.
If you don't have any questions in the queue, but Sam's contact information, including his email address, is on the last slide. So if he has any additional questions, feel free to shoot those with Sam. With that, we conclude our presentation. Thank you very much.